Welcome to the first video in a series that I plan to be a long-running fixture of the channel. In this series, I'll share my journey to become the richest man in Babylon. While you're here, like the video and subscribe so you don't miss the next update. Let's begin.
I like to be educated, but I'm so frustrated. Hello to my
George S. Clason's book, The Richest Man in Babylon, was published in 1926. And it contains a lot of very relevant lessons that we can take and apply to today. The book is a collection of parables and stories about personal finance set in the ancient city of Babylon. And although it was published nearly 100 years ago, there's a lot we can take from this book. Let me know if you want to see a book review on the channel in the future. So one of the key lessons is making your money work for you. This is a line echoed throughout the finance space. But what everyone wants to know is, what does this actually mean? So one of the key ways you can make your money work for you is through investing, not just putting money aside or spending it, but putting it somewhere where it can grow. In other words, you need to purchase financial assets. Financial assets can be anything from real estate to stocks, from Pokemon cards to gold bars. In other words, investing in financial assets is as simple as putting money into things that you believe will grow or produce an income. You can even have multiple assets, multiple investments that make up a wider investment portfolio. So how am I making my money work for me? Most of my money is invested in stock. I've been investing since February 2020 and my main portfolio is held within Freetrade, where I have a stocks and shares ISA as part of their standard plan. Stay tuned for a future video I've got planned about tax. But the important thing to note is that money invested in stocks and shares ISA is essentially tax-free. You don't pay capital gains tax and you don't pay any dividend tax while your money is held within the ISA. It's essentially a wrapper. The main drawback is that you're limited in the amount of money you can put in there. At the moment, the limit is £20,000 across all of your ISA types. I'll include some links in the description that cover this in a bit more detail. If you want to invest using Freetrade, you have the option to have a stocks and shares ISA, a general investment account, even a SIP. There's a massive range of stocks and funds available from the US, the UK, and even European markets. For example, you can invest in Allianz, Volkswagen, Adidas. In fact, I'm yet to find a stock that I tried to invest in that I couldn't because it wasn't on the platform. The standard plan at $4.99 per month includes a stocks and shares ISA, info about stock fundamentals so you can better research stocks, fractional US shares, automated order type. If you want to join me in my investing journey, I'll include a link in the description and a card in the corner where if you sign up and deposit £50, we'll both receive a free share of up to £10. So with that explanation out of the way, let's look at my investments.
So as we can see, my overall balance is in the red. I'm down £2,351.58, which means the total value of my investments is £17,754.97. So I've roughly deposited about £20,000 into Freetrade. So it's important to note that this doesn't cover the profit that I moved from my general account that I used before I opened my ISA in March 2021. So this covered about a year of the COVID pandemic where I was just over £1,000 in the green before I moved. So overall, since February 2020, I'm down about 1.3k overall roughly. This, I think, emphasises the importance of looking to the long term. So I believe in the companies that I've got investments in. There's a famous quote from Warren Buffett that says, invest in companies, not stocks. And I think the most important thing is to think about the portfolio in the sense of the long term, rather than being held up in the daily stock price. So if we look at the actual performance of the portfolio, it's been quite a brutal year. So there's been quite a lot of up and down volatility. We had highs in early January, then again in April, then again in August and September, and now we've crashed onto new lows. So an interesting feature from Freetrade is they actually give you the money weighted rate of return, which is a really interesting metric. So this actually takes into account the effect of deposits and withdrawals to show you your overall rate of return. So this is actually at minus 14% roughly. Then it also allows you to see the time weighted rate of return against the world tracking VWRL ETF, which I think is a really interesting comparison to make because a lot of people think the best option is simply to invest in a market tracking global ETF. So for anyone new to investing, ETF stands for Exchange Traded Fund. These you buy on the stock market similar to individual stocks, but in exchange for a small fee, you essentially get a basket of goods bundled together. So two of the biggest providers of these are Vanguard and iShares. So examples include those that cover the S&P 500, which tracks the 500 biggest companies in America. So in the case of a global market tracking ETF, one of the biggest is the one highlighted here, which is VWRL from Vanguard. So you would own a small amount of 3,754 of the world's public traded companies, weighted according to their size. So it's up to the provider to ensure that the basket accurately reflects the market over time, which is called rebalancing. So by this approach, you can just sit back and know this is all sorted for you. Historical returns over a long period of time suggest you can expect around a 7% return per year. But then there are people who think you can make better returns by picking your own basket of stocks. Some suggest it might be a fool's errand and that investing should be boring, and that picking stocks is just for people trying to get rich and day trade by chasing the next meme stock or cryptocurrency. Personally, I'm a believer that the truth is probably somewhere in the middle. I don't think chasing the next pump and dump stock for 1,000% returns overnight is achievable, or that you necessarily even want to. But then I do believe that if you invest in quality companies for the long term, that you believe are on the up, that have solid earnings, that you believe have the potential to grow, you have an opportunity to make quite a lot of money. So I spent a large amount of the year beating the market by quite a bit, but since September, this has obviously nosedived. So I really like this feature in Freetrade that allows you to compare your returns against the global market. So let's take a look at my actual investments. And remember, this isn't financial advice. You're more than welcome to disagree with my picks, but I'd love to chat in the comments about your opinions. My top investment is electric car giant Tesla. So I'm down 17% currently. Total position being near 11.6k with approximately 73.5 shares. Now there's so much I could go into with this company, which I'll save for its own videos. I'm constantly buying with any spare cash that I've got because I truly believe in the company. Tesla is an absolute bargain at these prices. There's whole channels focused on Tesla, including Dave Lee and Tesla Daily. So I won't go into too much detail as I've got a lot more to cover in today's video. But I'm a massive believer in EVs, renewable energy, battery storage, real world AI. Tesla is so much more than a car company. I'll include a graphic that best summarizes this, but Tesla's got its fingers in multiple trillion-dollar pies. For me, the question is whether they can execute on any or all of these opportunities that are in front of them. And I believe they can. They've shown it time and time again. So from a financial standpoint, we'll just cover the current situation. So the forward PE ratio is 33, and that's as of today. No growth factored in. For comparison, Amazon has a PE ratio of approximately 45. So Tesla's still growing. And even if you think that other exploits like full self-driving, solar, AI, if you think they're not going anywhere, even just continual growth in the car side of the business with new models such as the recently released semi-truck and Cybertruck makes Tesla an absolute bargain at the moment. They've got industry-leading margins of around 25%. And demand that's currently through the roof. Tesla's goal is to deliver 20 million trucks by the year 2030, and I believe they're fully on course to get to this. This is the best illustration, I believe, of opportunity within the stock market. If you can spot it, research it, believe in it, ride out the volatility, and are in it for the long term, there are massive profits to be made, not just in Tesla, but across the stock market. I would love to do a series of videos on Tesla, so would love to hear your thoughts on this stock. So next up is Apple. So I'm actually 15% up on my position in Apple, worth approximately £1,700 and with nearly 14 shares. Again, this is a company that I strongly believe in. Apple are a money printing machine and they're still growing. So from the quarter covering July to September this year, Apple reported a revenue of approximately $90 billion, which is crazy. That translated into approximately $20 billion of profit. Some might say we've hit peak iPhone and that the company's too reliant on their iPhone sales, which is true. But similar to Tesla, there's so much potential for expansion into other areas. So Apple's already explored the possibility of expanding into banking, creating original content such as Apple TV Plus, and developing additional hardware such as the upcoming augmented reality glasses that are in the works. I believe the main thing that's holding Apple back is the threat of a monopoly. Apple are simply too big. They face challenges everywhere they turn in terms of regulation. But still, Apple are a definite must-have for me in any stock portfolio. So my next biggest positions are UK Dividend and UK Property. These are both ETFs, and I've grouped these together as they're both UK focused compared to my largely US centric portfolio. These I picked because I'm really interested in dividends, where companies return profits back to the shareholders in the form of cash. So, UK Dividend focuses on large UK companies that have a high yield, and it crosses many of the core market sectors. This leads to a yield of around 8.45%, which is really, really good. So as you can see, my actual value hasn't increased too much, but I've received several dividend payments from this position. Similarly, UK property tracks an index of UK real estate companies. With this being a high yielding sector due to things like rent, this means the yield is approximately 3.4%, with money then flowing back into the pockets of investors. Although in terms of share price, I'm down 13%, this position is focused on cash flow, particularly as my position increases, rather than looking at the capital appreciation. I do also have a position in a developed market property ETF, which operates on the same principle, although has a slightly lower yield. But this is then diversified across the developed world, albeit largely US focused, with 60% of the holdings being in the US. So next up is SMT, which stands for Scottish Mortgage Trust. So this is an actively managed fund established 113 years ago and is one of the most popular managed funds on the London Stock Exchange. So they invest in global assets that they believe will show above average returns. Some of their top holdings include Moderna, Tesla, Amazon, Tencent. As you can see, my return isn't great on this fund, so I've been tempted to lose it in the past. But overall, I believe that having a bit more diversification, especially in the form of an actively managed fund, might not be a bad thing. So next up is US Tech. So this is another ETF, but this one's a basket of the biggest US tech stocks. This includes Apple, Microsoft, Google. So there is some duplication with the rest of my portfolio, but I thought it was important to capture the entire industry of US tech. So I'm actually 7% up on this position, which, considering the state of the rest of my portfolio, is quite a good result. So next is the MSCI World Quality ETF. So this is a really interesting one. So this ETF is a basket of stocks based on an index of quality, filtering out a market tracker to only include companies that meet criteria such as a strong and stable earnings, low levels of debt, etc. So again, these stocks are only included based on this criteria. There's no active stock picking going on. So the theory is that these so-called quality companies will offer a better return than just capturing the entire market. By annualized returns, this seems to be true. So since 1994, the quality index has returned 10.81% annualized, compared to a 7.52% annualized return for the whole world index. So the top three holdings in this ETF currently include Apple, Microsoft, and Johnson & Johnson. So again, some duplication with the rest of my portfolio, but I love the theory behind investing in a variety of so-called quality companies with clear criteria for what quality actually means. So I'm currently 1.68% up on this position, so it's quite a stable, if somewhat unremarkable return. Next is Renewables Infrastructure and Greencoat Wind. So these two I've grouped together, with both focusing on renewable energy generation. So both companies are FTSE 250 companies with a portfolio that covers storage, solar and wind projects in the UK and abroad. So both companies are focused on generating income from these projects, which is then fed back to the shareholders in form of dividends. So both have a yield of approximately 5%, which is really good, and offer what I feel are solid investments. I'm also up a small amount in terms of capital appreciation, but this is one similar to UK property and UK dividend that I'm mainly looking for cash flow from the dividends. So next is Palantir. Now this is a controversial stock, and at the moment I'm 50% down on my position, which obviously isn't great. So I'm not going to go over the controversy surrounding this stock, but fundamentally I believe their ability to grow. Data is such a fundamental aspect of the world now, and there's a lot of untapped potential in terms of government and company processing of data and the subsequent visualization. I'm just not particularly convinced on their execution, which is why my position isn't particularly large, and it's why I might be seeking to close this position in the near future. So to round out this video, I've bundled the final group of stocks together, and these represent the dividend aspect of my portfolio. Although I've talked about dividends earlier in the video, here I'm looking to create a basket of companies that I believe have solid growth potential, companies that pay out a strong dividend, global companies, and companies that cross the main sectors, and I want to be diversified across these positions. So briefly, these companies include Legal & General, GlaxoSmithKline, National Grid, various infrastructure and renewable energy projects, and also property investments. Some people say to focus just on growth, but I'm motivated by seeing actual money flow back into my pocket in the form of dividends. I feel like I own the company compared to just wanting the stock price to go up, which is often separate from the actual business itself. So we've covered quite a lot in this video. Hopefully you find it interesting. Leave a comment below with your thoughts on my portfolio and if you have investments in any of the stocks I've listed. Don't forget, if you're not currently investing with Freetrade, if you follow my link and deposit £50, we'll both receive a £10 free share. Don't forget to like and subscribe to the video. Thanks for watching, and I'll see you next time.
I like to be educated, but I'm so frustrated.